I think in our opinion, and part of our investment thesis is in a post-COVID world, you'll see some of that accelerate. And so that's why you've been seeing a lot of news stories about, well, if you had X amount of household income or higher in New York, you left the city. And many times you're not thinking about going back.
Mm-hmm.
We think that will continue to accelerate, especially if you were, a landlord in a dense tower deal that required mass transit commuting. I think that's going to be a challenge for a lot of employees moving forward. And then to your point, given the political tax ideology happening in the Northeast, I mean, Connecticut's a great example.
Mm-hmm.
Terrible budget issues, and Fairfield County, has the highest density of billionaires in the world, but Connecticut's broke. And so obviously there's going to be more transition towards tax and business friendly markets and territories. And I think you'll continue to see that moving forward. Some of the publications you see come out about Twitter and Facebook, how they're all going to be working remotely. If you actually break it down and read the press releases and talk to those folks, it's not that they're working from home. It's they're moving towards a hub and spoke model where maybe the mothership and HQ will be in San Francisco, Bay Area, or New York, but the majority of the talent will be spread across other secondary markets because that's what the employees want. And we fully feel like that's going to continue moving forward and probably accelerate in a post-COVID world.
Welcome to the Wealth Through Real Estate Investing podcast, your source for real-world strategies focused on creating long-term wealth, cash flow, and financial freedom through real estate. Through guidance, tips, and stories of highly successful real estate investors and thought leaders, we provide you the tools to succeed and reach the lifestyle you always wanted. And now your host, Dwaine Clarke.
Hello and welcome to the Wealth Through Real Estate Investing podcast. This is your host, Dwaine Clarke. And today we have Brian Adams. Brian is the president and founder of Excelsior Capital, where he spearheads the investor relations and capital markets arm of the firm. Excelsior is a real estate private equity firm that owns and operates high-quality multi-tenant office assets in emerging secondary markets. Brian, thank you so much for joining us on the show. And how you doing, my friend?
I'm doing well, thanks. Thank you for having me, Dwaine. I appreciate the opportunity.
Absolutely. Yeah, really interested in kind of learning more about this. We haven't covered this particular topic on the show regarding office. So I'm really appreciative to get you on and kind of pick your brain on how this area's sector is performing. So before we kind of kick things off, would you mind kind of sharing for us with our audience a little bit about your background and how you got started in real estate?
Yeah, absolutely. So I am a native New Yorker. I went to college in Connecticut, just up the road from where you are, Dwaine. I know we talked about that, at a school, small liberal arts college there. I met my wife in college, and she is a Nashville native. So we started dating in school. We both went to graduate school in Boston. That's where I went to law school. And I moved to Nashville about 15 years ago. I practiced law for a number of years. The way I got into the business is my wife's family has a single family office based here in Nashville that has experience investing in private equity, commercial real estate. We've done a lot of different things. We've been an LP in a fund. We've been a co-GP. We've done some direct co-investments in multifamily and office. And so once I joined the family board, I got exposure to some of the GPs and sponsors and deals that we were working on and just fell in love with the business. Started my own firm about 10 years ago with another New Yorker who married a Nashville girl. And, at this point, we have a portfolio of about 2.5 million square feet, roughly $350 million gross portfolio value.
Awesome. So what kind of drawn you to focus on the office? I know you guys started it 10 years ago, and I know there's a lot of different, changing. We interview a lot of multifamily investors, but what drew you to that particular niche?
Yeah, and that's a great question. One of the reasons that we started doing office deals was exactly to your point. We found that a lot of our core investors, who are all individuals and families, and some independent RIA, private wealth management firms, but non-institutional investors. A lot of them had exposure to triple net, single tenant deals. They had been doing a lot of multifamily, and they were starting to get into some of the more self-storage or cold storage data center deals. But oftentimes office was an asset class that if they wanted exposure to office deals, they really had two choices. They could go to a Blackstone fund of funds or a big KKR type of offering where they have no exposure to the management team. And frankly, the returns are not great once you factor in all the fees they get layered on. Mm-hmm. Or they had a buddy that they knew from the golf course that did a one-off deal every once in a while. But there was really nobody bringing institutional style asset management and deals to that, mass affluent accredited investor world. And, multifamily has become an extremely competitive space. Mm-hmm. We just felt like office, if we put our hard work in, that we could find decent deals. And it's really allowed us to differentiate ourselves in the marketplace where a lot of investors just don't have very good office exposure today.
Absolutely. And then kind of piggybacking off of that, because some of the kind of the institutional level office investors are primary focus in the primary market, you guys are particular focus on the secondary market. Kind of talk about your particular strategy on focusing on that particular area of the country.
Yeah, obviously we started out doing deals in our own backyard, and we frankly were just lucky with Nashville in terms of timing and when we were able to buy some properties and sell them, given the massive cap rate compression we've experienced here. But it made us realize that, we saw this demographic shift occurring within the millennial generation, because my partner and I are, on the outer edge of it, but we do qualify. And we saw a lot of our peer group becoming disenchanted with the cost and the quality of life of living in major metros, especially in the Northeast and the West Coast. And so we, hopefully had some foresight into these growth secondary markets that have experienced just tremendous population, job, and wage growth. And so we started looking around. Once we got priced out of Nashville, we started going to markets like Raleigh and Tampa and Columbus, Ohio. And we've since rotated out of those markets. We try to be very disciplined on pricing and cap rate, which we get into later. But we just thought that there was a great opportunity there to get outsized returns. And one of the things that we've done over the last 10 plus years, there's an old adage in real estate, I'm sure you've heard on the show, it's the same amount of brain damage to do a $100 million deal as it is a $10 million deal. And that's true for the most part, but there's huge pricing differential there. And so what we've done is created an investment thesis where we focus on that 10 to 20, maybe $25 million purchase price, which is above the local syndicators, above the local families, but below where the private equity groups will go. And there's just not a huge buyer pool there. And so we've established a good reputation and brand, and we have some pricing power there because, we've been doing this for the last decade or so.
Yeah, absolutely. And are you guys seeing, I know we'll probably see a little bit more data coming into the future after we kind of get through the pandemic, but I'm seeing a lot of news stories of big major corporations that are in the major cities that are considering moving into different marketplaces, just for many of the reasons that you were saying, but also taxes and regulations and mandates and things like that. Are you also seeing a lot of that data as well? And can you kind of comment on that?
We are. So just to give some perspective, millennials are roughly 75 to 80 million people total. And it's the largest working population in the history of America today. And we've all heard the stats about the number of baby boomers retiring or passing away. Mm-hmm. And anecdotally, we started seeing this on the individual side. If you were affluent and you had 1.5, 2 kids living in New York, the tax regimes were getting more and more difficult to make your life livable. And so there was this narrative, I think, unfortunately, along Wall Street that millennials were going to live in towers and eat avocado toast and never get married and never have children forever. And that's really where you've seen this huge run up in valuations in major metros and gateway cities. But the reality is, because of 2008, the Great Recession, millennials just deferred making those family formation decisions by 5 or 10 years. But now they're entering into that maturation phase where they are having children and they're increasingly making choices about where they want to live, work, and play based on access to single family homes, access to education for their children, and quality of life, cost of living. And so you've seen that play out on the employee side, and now you're seeing employers want to front run that process, plant a flag in markets where they know that human capital is going to be going. Pre-COVID, attaining and obtaining great employees was the number one challenge that businesses faced. I think, in our opinion, and part of our investment thesis is, in a post-COVID world, you'll see some of that accelerate. And so that's why you've been seeing a lot of news stories about, well, if you had X amount of household income or higher in New York, you left the city. And many times you're not thinking about going back. Mm-hmm. We think that will continue to accelerate, especially if you were, a landlord in a dense tower deal that required mass transit commuting. I think that's going to be a challenge for a lot of employees moving forward. And then, to your point, given the political tax ideology happening in the Northeast, I mean, Connecticut's a great example. Mm-hmm. We had terrible budget issues, and Fairfield County, has the highest density of billionaires in the world, but Connecticut's broke. And so obviously there's going to be more transition towards tax and business friendly markets and territories. And I think you'll continue to see that moving forward. Some of the publications you see come out about Twitter and Facebook, how they're all going to be working remotely. If you actually break it down and read the press releases and talk to those folks, it's not that they're working from home. It's they're moving towards a hub and spoke model where maybe the mothership and HQ will be in San Francisco, Bay Area, or New York, but the majority of the talent will be spread across other secondary markets because that's what the employees want. And we fully feel like that's going to continue moving forward and probably accelerate in a post-COVID world.
Perfect. Yeah, that's exactly what I'm talking about there. And I'm glad you kind of cleared that up for me. As far as kind of like your portfolio and your tenant base, is it more primarily, I'm just kind of piggybacking a little bit more off of your point, as far as kind of people in different sectors, they have their main hubs in these major cities. How is your portfolio balanced? Is it more for people that they're, once everything clears up, people's going to kind of go back, or is there going to be particular need, or is going to be any type of shifts and things like that?
Yeah, when we look at markets, we break it down as metropolitan areas with 1 million plus population, but outside the traditional top 10 gateway markets, like the Chicago's and the LA's, et cetera. And so today we're in a lot of places like Kansas City, Richmond, Virginia, Cincinnati. And what we like to see is we have a whole matrix that we put together, but one of the biggest things that we like to see is year-over-year population, wage, and job growth over the last, call it 5 to 10 years after the recession. And then we like to see counter-cyclical economic drivers. And so typically those are government, healthcare, education, and some form of knowledge economy or STEM economy. And that's why oftentimes we go to these type of markets. Now, we can get into this later, but I think it's really important when we're talking about suburban office and going to some of these metro areas, because they often lack geophysical barriers. They're not coastal. They can spread out massively. And so, for Nashville, for instance, if you live where I live, 45 minutes away, it's a completely different submarket. It's a different population. There's different metrics. And so we focus on not only MSA level, but we try to target 2 or 3 submarkets within the MSA that we feel comfortable going to. And then we really just try to stick to those submarkets.
Awesome. And as far as you guys being an owner operator, in the markets that you're in, are you guys doing more of things proactively as far as like sanitation things or interaction with tenants that maybe can give some tips for other, people that are interested in this market?
Yeah. So we are the owner operator of all of our investments, but we third party manage and lease everything. Leasing varies by market. It's all the usual suspects, Cushman, JLL, Iberia, et cetera. But we've started pushing everything on the property management side to CBRE because we think they're best in class. And they've released specific guidelines for all of their property managers to institute hand sanitizers, social distancing protocols. And so we're really relying on CB to have best practices there, as well as our council, to make sure that we are following the guidelines. It is, I would say it's a bit of a challenge because we're in 10 different markets and there's huge variability between what the guidelines are for Kansas City, Kansas versus Nashville versus Cincinnati. There's no real federal oversight or leadership on this issue. And so it's really come down to the specific state and metros that you're in. And that's where having third-party property management that's on the ground every day has been a huge benefit for us and our investors, because we can really rely on them to know what phase of opening they're in, what's allowable, what's not. And keeping the lines of communication with your tenants open is, I think, the biggest takeaway that we've had so far. And we've been very fortunate. We've had 100% rent payment. We've been able to make full distributions. But, moving forward, it's piecemeal. I mean, you're in the Northeast, what the city is doing versus the greater New York State versus, some of the other counties in Connecticut, it's very hard to track. And that's where the third party management is huge, because if we were self-managing everything, it'd be very hard for me to keep track in Nashville what territory was doing what or what jurisdiction was doing what. And it's very hard to fire yourself. And so I think that's a big benefit to having third party management.
Yeah, and as far as kind of like moving forward, looking at additional acquisitions, are you guys just going to be concentrating on the markets that you're in and just looking for new deals there, or is there any other markets that you're eyeing? And does the post-COVID, we know that eventually things will get a little bit better, things will start to ease as far as restrictions. Does that also weigh on your decision making as you look at additional markets? Because other markets have different opening protocols and political implications and taxing and regulation, things like that.
Yeah, I mean, we're actively looking at acquisitions now that the debt markets are starting to come back a little bit. We've seen sellers who had pressed pause on transactions in Q1 start to tip their toe back in the water. So we're evaluating a few opportunities right now. We reevaluate markets every quarter based on new information we get from the Bureau of Labor and Department of Labor statistics. So we're looking at some things in Charleston, South Carolina right now, continue to look at Kansas City. Cleveland is becoming an interesting market for us in some ways. So we have a handful of deals that we're looking at, but moving forward, it's interesting. I had the opportunity to be on to listen to an interview with Barry Sternlicht, owns Starwood, and he only owns one property out of, I think it's 300 million plus square feet that is in a politically Democrat controlled coastal city. And so, unfortunately, this is just the state of play. The reopening of the economy and how employers move forward is going to be extremely regional. And I think our personal theory is, Midwest and Sunbelt markets that have, business-friendly, tax-friendly, and Republican, for the most part, politics, they're going to be much quicker in the recovery than it will be if you're in New York or the West Coast. And so we are continuing to stay away from some of those markets just because there's more uncertainty.
Yeah, absolutely. I totally agree. And a lot of the guests that I've interviewed in the multifamily sector and all these different other sectors are saying the exact same thing. So I'm glad you kind of touched on that point. Kind of learn a little bit more about you. What's like a typical work day as the co-owner, and do you have any special morning routines?
Yeah, it's been interesting, pre-COVID, post-COVID. Pre-COVID, I would wake up at 4:10 in the morning. I would have a cup of coffee, do a meditation, and then go to the gym 5 o'clock and be home by 6:13. And that was really when my day started. So I've got two little boys, and my wife works. And so I would help kind of get the boys out the door and then hit the ground running, during the day. I was also traveling quite a bit. Last year, I took 154 flights, and was on the road a ton, finding deals, investors, and just a total road warrior. Post-COVID, I've really started to listen more to my body and the natural rhythms of it. And I've been more focused on getting sleep, frankly, and playing around some things like intermittent fasting, longer meditation sessions, and doing a lot of work on my rower and Peloton, because I don't know when the next time I'm going to be going into basement, high intensity gym is going to be with 30 other people. I just not sure I can get comfortable there. And so it's really made me rethink some of my morning routines that I've been doing for the last like 5 years since my second was born. And so it's a topical question because my routine's been totally changed. And I'm not sure, when we go back into the office in 2 weeks, whether I'm going to keep or permanently shift some of the things that I've been doing. But right now I feel like I'm much healthier. I'm spending more time outside, getting more sleep, and listening more to just the natural rhythm of my body. That might be too much information, but
no, that's great. That's what I was looking for, because I always ask all of our guests and it's interesting to know. And actually a lot of our listeners get a lot of insights out of it and what, other people are doing and, what's kind of benefiting. But it's interesting how, people kind of evolve their morning routines, now that we're in this situation. And now that things are slowly starting to open back up, people are like, well, maybe I'm actually feeling a bit better. And so it kind of gives you some time to reflect on things that, benefiting you and your family. So that's awesome.
Yeah, I used to be very regimented. And I found that, especially in the morning, my creativity is much better than it used to be if I'm getting full sleep and just kind of waking up more naturally. And so even doing things like this podcast was something that I probably wouldn't have done before, but just trying to be a little bit more creative and proactive with telling our story and helping other people in the business like yourself. So.
Absolutely. What I always ask people at the end of the interview, what are you most grateful for? So what comes to mind for you?
Yeah, I mean, my wife's family, they, for the most part, all work in the medical profession. So they're at Vanderbilt Medical Center. And we had a family friend that got really sick with COVID. So honestly, I'm just grateful for the fact that my boys are healthy, my wife is healthy, my investors have been terrific. We closed an acquisition last Thursday, which was just a ton of work by our team, putting the debt and everything together in the equity. So I'm just grateful that if the worst thing that occurs to us as a family unit during this time is that we have a ton of boredom, I think we'll be very, very, very happy.
Absolutely. So how do we get in contact with you? I know we'll put all the information on the show notes, but any information you're willing to share with us?
Yeah, so we have a website, obviously, excelsiorcapitalgp.com, and then I'm very active on LinkedIn. So if you want to shoot me a message or look up my information, always open to a phone call, and those are probably the two best ways to get a hold of me.
Awesome. Yeah, we'll make sure I'll get all that information, all those links on our show notes, and anyone who is also on LinkedIn, make sure to connect with Brian. And like I said, it was a great conversation to have with you before our podcast interview, and just learning a little bit more about your company in the office market, which is very interesting. And again, if anyone have any questions, I always reach out. So Brian, I really appreciate you taking the time with us, learning more about you and your business, and look forward to connecting with you again soon.
Thanks, Dwaine. I really appreciate it.
All right,
Thanks for joining us on this episode of the Wealth Through Real Estate Investing podcast. Don't forget to subscribe and leave us a review on iTunes or the listening platform of your choice. Also, please check us out at DwaineLClarke.com, as well as find us on Facebook for more useful content and resources.